So I get this call a couple of weeks ago, and this guy is straight up panicking. He's like, Ramin, man, I thought I was being smart. I bought a fourplex last year, but now my CPA tells me I owe 32,000 bucks in taxes. Bro, I don't have 32,000 bucks. What do I do? So let me be clear. This guy is not some tech millionaire. He's a firefighter from Phoenix who worked overtime, he skipped vacations, and he saved for years just to buy that fourplex. But he made one mistake that 90% of investors make all the time. He used a regular accountant, and what do regular accountants do? Well, they treat your rental property like it's your house, just with tenants. So they throw it on a straight line depreciation schedule. 27 and a half years later, in his case, that meant 14,500 bucks in write-offs per year. So not bad, but not even close to what he could be doing. And here's where it gets really fun. I'm going to break this whole thing down for you, and I'll tell you how people are getting $80,000 to $120,000 in write-offs in year one. And if you're a small investor, a landlord, or even a first-time buyer, well, this is going to apply straight to you. And just wait until you hear the cheat code I'm dropping at the 5-minute mark. That part, well, that's where the IRS basically lets you borrow their money at 0%. So let's get into it. So let's start simple. That fourplex, on paper, it's a $400,000 building. Traditionally, you depreciate that over 27 and a half years. That's $14,500 per year that you can deduct. But here's what no one's telling you. That building isn't one huge thing. It's dozens of little things like carpets and cabinets and appliances and HVAC and electrical systems, all with different lifespans. Cost segregation is a legal strategy where we go to the IRS and say, hey, the fridge is going to die in 5 years, the carpet maybe it'll last about 7 years, so let's write off that stuff a little faster. So instead of $14,000 a year, you might be looking at $90,000 to $120,000 of accelerated depreciation in year one. And boom, that's your tax bill, gone. And maybe even a little refund. So let me give you a straight up example. Lena, she's a small business owner in Austin, Texas. She bought a $600,000 office building for her consulting firm. CPA was giving her $21,000 a year in depreciation, pretty standard. But when she came to me, we brought in a cost segregation engineer. 3 weeks later, 240,000 bucks in items identified that could be depreciated faster over 5, 7, or 15 years. So year one, instead of owing 18,000 bucks, she got a refund for 31,000 bucks. That's a $49,000 swing. The cost of the study, 4,500 bucks. You do the math. So quick disclaimer before we go any deeper. Look, I'm a loan guy. I help people buy buildings. I'm not a tax specialist or an advisor. I definitely am not a CPA, and I don't play one on YouTube either. So what I do is bring smart people to the table like cost seg pros and CPAs to help my clients keep more of their money. So always run this stuff by your tax advisor, but don't ignore it just because it sounds complicated. That's exactly how you miss opportunities. Now, hold up. I can hear you thinking, yeah, but Ramin, that's for rich people. I just own a duplex. Stop. That's a lie. This works for duplexes, threeplexes, fourplexes, Airbnbs, rehabs, small apartment buildings, even commercial property, anything under $1 million. The truth is, you don't need to be wealthy. You just need to know the rules. But here's the kicker. You can't do this on TurboTax. You can't have your cousin who does taxes on the side run this. The IRS, well, they want an engineering-based study, square footage, materials, the full report. But if you do it right, it's like unlocking a hidden chamber into the tax code. Okay, here's the part most people miss. Cost segregation isn't about write-offs, it's about timing. So let's say you have a big income year. Closed a bunch of deals, got a fat bonus, flipped a property, sold some stock. Well, you can use cost seg to create paper losses that wipe out that income. Now you're keeping your own money instead of sending it to Uncle Sam. But it gets even better. So let's say you sell that property down the line. Normally you'd owe depreciation recapture, tax like regular income. But if you do a 1031 exchange, you roll that into your next property and defer the taxes indefinitely. Now, you're not just saving taxes, you're building an empire on borrowed IRS money. So let's go back to Jason, the firefighter. We brought on a cost seg team. The study cost them something like 3,200 bucks. They found $95,000 in accelerated depreciation. He didn't just eliminate his $32,000 tax bill. He got an $8,000 refund. And then he used that refund as a down payment on duplex number 2, which turned into duplex number 3. Now, Jason owns 7 rental units on a firefighter salary. That's not a guru course, that's just smart tax strategy. Now, here's where people mess this up. They either don't know it exists, think it's too complicated or try to do it themselves. Listen, this is not a do-it-yourself project. It's not a TikTok hack. This is real IRS-vetted, engineering-based tax work. But when done right, the return is usually 10 to 1 or even better. And the longer you own the property without doing it, well, the more money you're just giving away. Look, I'm not saying cost seg is for everyone, but if you bought an investment property in the last 10 years, you're holding real estate with equity, you've done significant renovations, or you've had high income recently, then this is a conversation you absolutely need to have. You're not eliminating taxes, you're controlling them. And in this game, control is everything. Because when you understand how the tax code works, it's not just what you earn, it's what you keep. And that's why I'm doing a Zoom session on July 16th. I'm bringing in Geraldine Serrano, a cost seg expert who does everything this way. Plus, I'm also bringing a CPA who knows this stuff inside and out. We're walking through real examples, live Q&A, and exact strategies you can use right now. This isn't some boring tax webinar. This is the cheat code you have been looking for. Link is in the description. Spots are very limited. We're keeping it tight so it's interactive. If you own property, if you've paid more than $10,000 in taxes in the last few years, you need to be on this call. Don't be like Jason before he called me. Be like Jason now. Building wealth door by door, tax bill by tax bill. Subscribe if you want more real talk, no fluff, no junk, just straight up strategies that help you keep your money and grow your portfolio. And hey, if you got a friend who owns a property and doesn't know about cost seg, send them this video. They'll owe you dinner. I'll see you guys on July 16th. Until then, keep your money tight and your strategy tighter. See ya.